Stocks are up, but investors are looking fragile as market price action behavior is starting to unwind. Investors are choosing megacaps over the broader market in what looks like a flight to quality, as highly leveraged and capital-intensive sectors were all sold off as a result. So should we be concerned, or is this simply the megacaps leading into new all-time highs, and will the broader market follow? Today, we're going to answer all of those questions and dive into GDP. There were some massive changes after today's horrid manufacturing data, and it will have serious implications for price action this quarter. We're also going to be looking at some interesting seasonality stats and where we want to be positioned into 2025 and 2026. The truth may surprise you. So we've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. And it was a crazy day for the market. This is the S&P 500 heat map. Very glaring things. We can see Nvidia, Amazon, Google, Meta, Apple all put out pretty green days. So it really was a mega cap rally, although Microsoft and Tesla didn't quite participate. We also saw huge outperformance here in healthcare stocks, and that was really it. We had pretty much red everywhere else. Energy was very red. Same too with financials. But diving a bit deeper into the details, we saw semiconductors were up 1.25%, then healthcare 0.7%, GDX 0.59%, XLC 0.4%, and then XLK. So we had gold miners perform really well. That had to do with the price of gold, and then pretty much the mega caps rallying, taking the SPY up 0.08% here for the day. And then every other sector underperformed and actually lost on the day, including staples, discretionary, and software. So it was a very horrid day for the market. And part of the reason actually had to do with some data we got today. It had to do with the manufacturing data. It came in pretty poor. I mean, global manufacturing PMIs was the only upbeat number right here, but then we had construction spending actually fell on a sequential basis. Crazy stats. Employment index was at 51.1. That was all right. New orders index at 45.4. Manufacturing PMI here in May, 48.7. The expectation was 49.6. Our prices paid came in at 57. We were expecting 60. And then we also had a couple of bond auctions, but they didn't cause a lot of volatility. And so, yeah, the market got concerned with growth. As a result, yields came down, commodities pushed up, and that led to the price action we saw. And if we actually have a look at the Fed's GDP now, after the data released, it fell to 1.8% from pretty much the highs here above 4%. And this week being very close to 3.5%. It's now at 1.8%. And the market definitely did notice. And that's part of the reason why we got the price action we did here in the S&P 500. You can see by this wick right here that we had quite a volatile day. This wick indicates that the market did come down all the way to as low as the 5250 level, but we did actually par a lot of those losses. A lot of the growth concerns got pushed out the way later on in the day. But just before we dive into the S&P 500 more on a detailed basis, let's have a look at what the market did. So the S&P 500 was up, same too with the Nasdaq. The IWM fell, the RSP fell, midcaps fell, S&P 600 fell. They all fell anywhere from 0.43 to 0.77%. And looking a bit grim here in extended hours trade, we actually look at the yields on the back of just what was terrible data. Yields fell as well, and that was a bit of the dynamic we saw here in the market. So if we actually have a look at the S&P 500, dive into the 5-minute chart, you can actually see that we gapped up. The data got released, we sold off, and then as the market started to realize that yields were moving lower in a very significant way, markets actually parred a lot of the losses they made in the early session. So we can actually see, if we look at the 10-year yield up on the daily chart, very interesting dynamics. It was down 2.44%, and as a result, bonds outperformed for the most part. We saw the TLT up 1.27%. We saw the AGG up 0.29%. And just for the record, the TLT, I advised everybody to go long right here. It's been a very solid trade. We've actually put in a higher low, and we got break this high. That probably means that yields are probably going to continue to come down. Bonds going to keep rallying. And we're going to talk about the bond trade a little later on in the video. So stay tuned for that. Now, looking at gold today, we actually saw a pretty big move up 1%. That supported gold miners. We then saw silver with another green day as well, 1.26%. But if you actually have a look at it off the lows, it would have been maybe a 2% move plus, and then the dollar actually fell. So really what happened today was a lot of dynamics. It was the market trying to price in overall economic growth, and then the immediate factors like yields and the dollar affecting overall price action. And that's why we actually moved up in the S&P 500 here today. Now, we actually did find strong support in the S&P 500 here today at the 5250 level. It's the same level we've been looking at for a very long while. Yesterday, I said it was the 5200 level where we're going to find support. This week, it was the 5250 level, and we actually did find support right now. And what this pretty much looks like, it's just a higher low. You can see we put a higher low right here, higher low, higher low, higher low. If we actually go ahead ahead and break an all-time high, this is a trend continuation despite all of the data and earnings that's coming in this week. If we do go put in an all-time high, this is literally a trend continuation. So what needs to happen for the rest of the week? Well, as long as we're above the 5250, we're buying dips in this area, looking for 5300, looking for 5400. That is the gamma flip zone. But for right now, I think we need to look for the 5300 level if we do get to the 5250, if we are buying dips, and then we can also look to the 5400 level if we are buying dips. If the market does break this 5250 level, I think we're going to find support, very strong support here at the 5200 level either way. So a lot of support on the way down. A lot is going to be dependent on the data we get at the end of the week though. So watch the data and the price action will follow. Now guys, looking at some seasonal stats, this is a very interesting price action pattern. It's the S&P 500 performance after we've had 4 up months, then 1 down month, and then the next month is up. So in 2024, this was pretty much January, February, March, April being up, then the entire month through April being down, and then the rally we saw in May. And what are the returns we can expect for the first month after that, the second month after that, and the third month after that, and then the 3 months combined, which they call a quarter. Now this has happened 36 times, and the returns we can expect in the first month tend to be quite lackluster. 25 wins, 11 losses, 25 and 11, so still positive nonetheless. Average return 0.89%. Then the second month, roughly the same, 24 and 14, 0.99% average return. The third month gets very interesting, 29 and 7, 2.17% average return, and the full quarter 31 and 5, 4.03% average return, 3% moves or higher, 21 and 2. And if we actually look at the max drawdown, in the 36 times that this has happened, we've only had 2 years of double-digit drawdowns here in 2018 and then again in 1998. So it does go to show that we can actually expect drawdowns in this period, but it should just be looked at as dip buying opportunities because the returns tend to be very, very positive. And by buying the dips, by buying these drawdowns, which tend to be in the mid to low single digits, we can actually get outsized returns relative to the average return at the end of the quarter. Now, with that in mind, where is sentiment sitting right now? Now, this is the Beaufort Bull Bear indicator sitting at 5.5. It was at 5.6 last week, so we've had a bit of downward momentum. And then the Goldman Sachs sentiment indicator sitting at 1.3, so still in stretch positioning, but coming off the highs it's been in the last couple of weeks. And both these indicators are still telling us to hold equities, but that sentiment is lightening up a bit. We're moving down from the highs in stretch positioning, as well as decreasing here in the Beaufort Bull Bear indicator. So it's not necessarily a reason to sell, and both these sentiment indicators are telling us to hold and buy dips and sit through the volatility. Now, there's a number of things that could bring the volatility this week, and one of them is data. Now, this week's data, the focus is going to be on ISM manufacturing numbers, the April JOLTS report, as well as the NFP report here at the end of the week. So today we got the ISM manufacturing numbers as well as the PMIs. Tomorrow we get the JOLTS openings, the factory orders, and then ISM services. Then here on the 5th, we get mortgage applications as well as the ADP report, and then US services PMIs, as well as initial jobless claims. And then on the 7th of May, we get the non-farm payrolls. We get the private payrolls, the unemployment rate, average hourly earnings, and average weekly hours. Now, the consensus expectation is 185,000 here in non-farms, 170 in private payrolls, a 3.9% unemployment rate, and then average hourly earnings month over month of 0.3, and average weekly hours of 34.3. Now, BOFA expects slightly upbeat data. They expect 200K in non-farms, 180K in private payrolls, a 3.8% unemployment rate, so slight decrease compared to the consensus, and then average hourly earnings, average weekly hours, the exact same as the consensus. On top of data, we also have earnings this week. Now, tomorrow after the close, we have CrowdStrike and HP. Those are the only real two that's going to provide volatility, particularly in the cybersecurity space there. Then on Wednesday, we have Dollar Tree, Lululemon, I guess Victoria's Secret if you want to look at the discretionary space, as well as Campbell's before the open. And then Thursday, we got like Neo, DocuSign, Samsara. That's really it for the week, a very light week of earnings. So I don't think earnings is going to bring volatility in individual names. Yes, maybe in the discretionary space here on Wednesday with Lulu and Dollar Tree, and with CrowdStrike on Wednesday. That's really the only volatility we'll see. Earnings has pretty much wrapped up, and you guys know the go. I show you guys this pretty much every day. S&P 500 earnings sitting at 8%, S&P 500 revenue sitting at 3.8%. And you know we've had a very good earnings season, beating the expectation of 3.5% on revenue and earnings. But this is Q1 earnings, and we should really really start looking at Q2 data, and I have the data here for you guys. The expectation for revenue is 4.7% and the earnings expectation is 9.2%, with the same sectors providing the same alpha as Q1. We're looking at stuff like comm services, discretionary, and technology providing the biggest amounts of revenue growth as well as earnings growth for the quarter. And we've actually seen mild upward revisions. Now, I know this says start of earnings season, but this right here is actually what the earnings expectations were on the 31st of March. We've actually seen some mild upward revisions. 4.7% as of today is the expectation against 4.6 and 9% against 9.2%. And this should come as a surprise to nobody. We've seen S&P 500 consensus estimates for the second half actually slightly rise here in the S&P 500, mostly driven by the Mag 7, but excluding the Mag 7 and technology as well as energy, we've actually seen downward revisions of 0.2, 0.2, and 0.1% in the overall market. So things are looking good, but again, driven by mostly up revisions by the big players. Now, where does earnings leave us with valuation for 2024? Now, right now, the S&P 500 on a forward PE basis trades at 20.5 times, a PEG ratio of 1.2 times, a free cash flow yield of 3.3%. I know that says X right there. And then a 4.8% PB, EV to EBITDA 15.3, and then 3.1 times EV to sales. So, fairly overvalued on most metrics. I would say forward PE and PEG look fairly reasonable. Free cash flow yields kind of abysmal, but everything else is actually looking pretty good if you ask me. But we're not going to look at past valuation metrics. We're going to look more towards the future. And I managed to pull some data here. So the compounded annual growth rates for revenue, earnings per share, and free cash flow into 2026. So this includes 2025 data, 2026 data, and then right here, I got the current 2024 forward PE. So this extrapolates earnings for the next 3 quarters, and you can see the S&P 500 currently sits at 20.7 times. I've done this for every single sector. Now, this is very, very interesting. Let's actually dive into technology because it is arguably the most expensive sector, trading at 28.6 times earnings, by far the most expensive sector. We actually look at the sales growth, 5.4%. Look at the EPS growth, 13.6%, and then its free cash flow growth into 2026. Don't forget, this includes 2025 growth, 2026 growth compounded, and the free cash flow sits at 15.9%, but that trades at a 28.6 times earnings. Let's compare infotech to industrials. 8.6% sales growth, it beats technology. EPS growth at 15.9% beats tech again, and then free cash flow 16.7 beats tech again, and it only trades at 21.2 times. Significantly undervalued compared to technology. So isn't industrials over the next 2 years a better investment? Very, very interesting when you look at it from that perspective. But there's a couple of other very attractive sectors. Look at something like materials, 3.5% sales growth. Again, this is dependent on commodity prices. So there's a lot of cyclicality that you do need to consider with something like materials. But look at its EPS growth, 12.8% relative to technology. And look at the free cash flow compounded annual growth, 26.1%, and it only trades at 20.3 times compared to tech's 28.6. Let's look at the cheaper sector here, energy. Its sales growth is actually negative for the next 2 years, but its EPS should be 8.2%. The companies are finding operating leverage, becoming more efficient. And then free cash flow compounded annual growth, 7.7%, currently trades at 12.1 times. So there's definitely value to be found in the S&P 500. And you can see, if you actually look at all of these stats combined, S&P 500 sales into 2026 is at 5.8%, EPS at 13.2, and then free cash flow at 15%. Very, very good free cash flow. And the S&P 500 currently trades at 20.7x. Again, this is 2024. And if you look at 25 earnings, the S&P 500 currently trades at 18.5. And if you look at 2026 earnings, the S&P 500 currently trades at 16.1. So very reasonable valuations, especially if you look out into the future. And you can even find far more value if you dive into individual sectors. Stuff like comm services, stuff like energy, financials, healthcare, industrials. There's a lot of value to be found in the S&P 500. Now, diving into the economy and looking at some measures of growth, we got GDI, GDP, and then final sales to domestic purchases. So this is gross domestic income. And then GDP right here, we all know what that is, gross domestic product. And then final sales to domestic purchases is essentially GDP minus government consumption, inventories, and a couple of other measures. Essentially, this figure is to GDP what core inflation is to PCE. And you can see that final sales to domestic purchases has been very, very robust in the recent quarters and has been for quite a while. And when it hasn't been as robust as it has been in these recent quarters, GDI and GDP has actually picked up the slack. Pretty much measures of growth continue to point to a very, very healthy economy. Now, looking at what makes up GDP, we can actually see that fiscal policies have led to a surge in private and public investment, but that appears to be slowing. Contrary to popular belief, we can't just constantly print money, and we can actually see that state and local investment as well as non-defense and federal investment is actually moving lower. That is part of the reason why we're actually seeing quarterly GDP growth decelerate. However, this is not necessarily a bad thing. All it simply is GDP reverting to its mean. Remember, right in here, we injected $1.7 trillion worth of money into the economy, and a lot of those impacts started to only be felt here at the tail end of 2022-23, and still a little bit here into 2024. Now, even though these contributions to GDP are decelerating, it doesn't mean we're going to have a negative GDP figure. You can see that in 2024, expectations for GDP is to come in at 2.8% in the second quarter, 2.4% in the third and fourth quarter, and then to remain very robust from 2 to 2.2% throughout 2025. So despite the deceleration we're seeing in fiscal, we still should see healthy economic activity because all of that money gets put to work in the economy by good capital allocators, and then for years and years and years later, they can compound that capital. That's exactly what we're seeing right here. But again, GDP is expected to decelerate, reverting back to its mean. Now, all of this has to do with US GDP figures. What about the rest of the world? And we're seeing very, very similar trends because this chart just outlines consensus 2024 real GDP year-over-year estimates. Look at the Asia Pacific GDP growth right here and European GDP growth. We've remained in a fairly downtrend and or stagnant trend for most of 2023, 2024, but we are starting to see life here in the Eurozone as well as the Asia Pacific. We're seeing robust growth here driven by China, driven by Japan, and then in the Eurozone as well. And we should expect this to continue to tick up well to the 2% range here in Europe, especially as Europe rebounds and the rest, especially as Europe rebounds. Normally what happens is US leads and the rest of the world follows. That's why the US is the leading market. That's why the US are the leaders in the market, because they lead the market. And that's what it means to be a market leader. You tend to be first and everybody else follows. Now, what about yields? As it is right now, US yields currently are in sync with the underlying data. This is the US 10-year predicted 3-month forward, and you can actually see here that this model sees the US 10-year yield at around fair value right now. We are starting to see inflation data soften, economic data soften, and that's because yields are starting to have their effect. And it's a good thing that the Fed didn't raise rates, and from here we can probably decrease rates, especially as the economic data weakens, because if yields are at fair value, the economic data weakens, inflation comes down. That means, and real yields move higher as well, then they go from fair value into overvalued. How do we get them back to fair value? We cut rates, and that's exactly what we're going to see in the second half of 2024. And even though this is just for the US, generally speaking, whatever the Fed does, the rest of the global market will follow. So generally speaking, we can expect rate cuts for 2024. The economic data and the economic trends are supportive of that. And BOFA had some commentary with regards to yields. They said pain equals gain. Political polarization, protectionism, war, inflation, supply, even Saudi Arabia, of course, on record, even Saudi Arabia on course for record bond issuance in 2024 means secular bias strike in global government bonds is valid, but cyclical, always able to trump secular. And we say 3 P's of positioning, profit, and policy means second half reversal of anything but bonds trade, buying any dip in bond prices for credit and stocks, sell the first rate cut is still the call. So pretty much what they're saying right here is that when we get the first rate cut, that's going to be a buy the rumor, sell the news for equities. And at that point, that's probably when you want to buy bonds, despite all the negative news going on in the market right now. And they're obviously talking about when the Fed is going to cut rates and not any other country. At the same time, they also made this little cool note right here. The price is right. Equity breadth worst since March 09 as AI crowds Wall Street and Main Street dollars. 2020, just one pain trade after the other. Next is value outperforming growth stocks plus breadth winning as economic growth slows. Catalyst is benign. Anything less than 0.28% April PCE unable to support wobbly technology. So again, both see pain trade to continue and the next pain trade to actually be technology and value stocks outperforming growth stocks. As breadth expands, the market broadens and inflation falls. Looking at gamma, not much has changed from last week into this week. The 5400 is still the core resistance area. 5200 is still the put support. This will always be a very, very strong support zone for the market. This is where bears are going to look to bounce at the very low end. But we can also see that 5275 is now the gamma flip zone. We are actually in positive gamma. We're slightly above the gamma flip zone right now. That did move down. That is a bearish indicator, but the ultimate bearish indicator on this chart is if this moves down. That has not been the case, and we've also seen the put support move up last week from 5,000 to 5,200, and that is going to support price overall. So you want to be a buy, you want to be buyers of dips here at 5275, 5250, 5200, and you want to look at targets at 5300 and 5400. Now diving into seasonality, this is just election year seasonality, and essentially in presidential election years since 1950, you can actually see that around this time right here, around the 100th, 111th trading day in the year, this is when we really put a bottom in, break these highs, and then see a massive rally. Is that going to happen this year? I do think so. I think the melt up is still well underway, but all we have to do is just get through some of the data, some of the earnings, some of the price action in yields. Once all that uncertainty is in the rear view mirror, we should continue onward and upward. It's going to happen very quick. So buy dips, the melt up is still alive. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.